Good afternoon, everyone, and thank you for attending. We're going through some unprecedented times and the markets have yet to stabilize. Unemployment rates are still very high and it's unlikely that a full recovery will not take place for months or potentially years. Today's webinar, we're going to discuss some opportunities to manage your financial life to capitalize on some of the turmoil that we've been experiencing. My name's Ari Fishman. I'm a certified financial planner. I have a specialty in all things insurance. I also have a strategic partnership with Telemus in which I work with all of their clients and many of their advisors to help them build strategies to transfer wealth in an efficient and effective manner. I have with me Aaron Sherbin and Marco Belle, who are two great attorneys from Jaffe that will answer our questions throughout. Jaffe has really done an exceptional job of communicating all sorts of marketing material as pertains to, or informational material as pertains to PPP, returning to work, estate planning, in very simple manner that you can really understand, and that's on their website. I've personally referenced their material multiple times over the past few months. Aaron Sherbin is a partner at Jaffe. He leads the estate and wealth planning practice groups. He specializes in trust administration, wealth preservation and transfer, along with strategic business planning services for closely held family businesses and families. I've had the pleasure to work with Aaron and several other members of the estate planning team at Jaffe throughout the years, and they're all exceptional. I also have Marco, who's also a partner at Jaffe. He leads the firm's tax practice group. He specializes in corporate and real estate tax matters. He helps with the tax planning from transactions such as acquisitions, startups, and helps figure out the most creative, sophisticated tax solutions from start to finish, some start to sale. We're going to start some of the questions that we've been getting a lot. So welcome, Aaron, Marco. It's a pleasure to have you here.
Thank you. Hi, awesome. Nice to be here. Thank you.
Yeah, thank you for that introduction. Very, very generous.
Great. Well, so we've all been getting a lot of questions throughout. I mean, this is really an uncertain time, and some of these questions seem to be consistent. So what we've decided to do from a format perspective is take some of the most frequent questions that we've been getting and start off with that to open up the topic. And then all throughout, we encourage everyone to ask questions along the way. There's a Q&A box on the bottom, just type into it and ask your questions along the way. And we will try to get to all of them as they come across. So we're excited to have them both on and we're ready to get started. So the first question is to both of you. Since the pandemic has started, what really is the most common question, concern, and what type of guidance are you giving to address these questions that you've been getting and or concerns or anxieties that clients are facing during these crazy times?
Yeah, so Marco, I'll start. I'll take that one. Obviously, with the COVID-19 pandemic, what I'm seeing most is clients' concerns about having, their healthcare proxy in place and making sure that they've got people appointed to make medical decisions, and also making sure that those powers of attorney or proxies are particular in the way they describe how they want certain medical treatment, particularly intubation and ventilation. But also, it's also raised concerns with clients about getting their general overall estate plan up to date, or if they don't have a plan, getting one in place. And then finally, I'm also seeing clients who are concerned about making sure their parents have updated or have an estate plan in place, or their children who have reached 18 or older.
That question actually just came up to me yesterday as far as for adult children who are 18, as far as what type of planning they would need. So they may not need a comprehensive estate plan, but what would you do for someone who just reached majority age?
Yeah, I think at a minimum, anyone who's over the age of 18 should have a will, which would leave their assets, should something happen to them, to the people, family members they want to leave those assets to, and then have powers of attorney in place where they're designating people to make decisions for them, whether they're financial decisions or medical decisions.
Great. Marco, how about you?
Yeah, lately, it's not necessarily a tax issue, but I've been spending a lot of time with the PPP loans. It's been a hot item, and Congress has come up with a few bills. There's been guidance from the Treasury and from the Small Business Administration that is contradictory. So it's generated a lot of questions. It's been like practicing on quicksand to try to sort those questions out.
And I mean, for the most part, have your clients been taking the PPP loans or SBA loans?
Yeah, we have a fair number who have met the qualifications, and then when there was this conflicting guidance as to what counts as needs. So some were kind of second guessing, where we're debating whether to give it back. Then it turned, then that kind of swung the other way. So there have been a fair number that have obtained PPP loans, and now it's in the phase of the money's already is all doled out. Now it's a matter of applying. So there are some who are kind of in the midst of their time period for expending their funds or approaching forgiveness. They want to make sure that they're maximizing their forgiveness and then completing the application, which now will be revised, but in a manner that would maximize their forgiveness.
Right. This has really been from an interesting time from perspective that, I don't remember any time in my career where there's been so many events that have happened where people have to make quick decisions and try to do their best to get all the information that they need to know the ramifications of those decisions, and then that they stay compliant. So, from clients who've taken the loans, are you helping them along the way in terms of making sure that they're compliant and they're not going to run into any trouble later on?
Yeah, it varies as to what depending on the client's sophistication, what sort of guidance they're coming to us for, to work through some of them are more hands-on and will come to us with specific questions.
I'm going to follow up on that. Some investors are looking to defer gains and put the money into opportunity zones. Has there been any relief here?
Yeah, we've just received. There was one round where the IRS had extended the date, because the key with opportunity zones is, or one of the requirements is that investors who have gains that they'd like to defer have to put those gains into a qualified opportunity fund within 180 days of the date that they would have otherwise recognized it. So for some folks, they were coming up on that, in an environment where everything is shut down. So after a second round of relief, the IRS has now provided that if that 180-day deadline would have come up, or that 180-day period would have ended between April 1st and the end of the year, you now have until December 31st to reinvest that. It's particularly helpful because of the way the rules work. With flow-through entities, there are a lot of gains that were treated as recognized at the end of 2019. So you'd have had 100. So from December 31st, 2019, you would have gone into that period after April 1st. So that gives you now the possibility to invest that gain at any time until December 31st. And from the fund has certain compliance requirements as well, like maintaining on 2 different testing dates that 90% of their assets are good, and those have been forgiven, or essentially ignored from the fund perspective of compliance from April 1st through December 31st.
So these times are the interest rates are really at historic lows that we haven't seen ever before. We have, and it's creating there's a lot of things right now that kind of make this the golden age of planning, from low interest rates and very high exemptions from estate taxes, and historic low tax rates as well. So we're going to get to all those in as the time progresses. But I want to start with interest rates. Aaron, with these historic rates, what kind of opportunities does this create from a planning perspective with your clients?
Yeah, so we're talking about currently low, very low interest rates, and when we talk about interest rates in the estate planning world, we're talking about the interest rates that are promulgated and issued by the IRS. I'm not talking about the prime rate or LIBOR-based rates. And those IRS rates right now are at historic lows. So those rates coupled with, depressed asset values create some very good opportunities. And the couple that come to mind, the ones we're doing most often right now, are one, Grantor retained annuity trusts, or GRATs, G-R-A-T, Grantor Retained Annuity Trust, as well as Charitable Lead Annuity Trusts, or CLATs, C-L-A-T-S. And basically those techniques, so the GRAT is a technique where the client would transfer assets at these lower values to a trust and take back an annuity over a period of years. We generally recommend, a 2-year GRAT, and take back an annuity equal to what they've put in, plus this interest rate that the IRS prescribes, which is right now 0.6%. That's 0.6%. And so when you structure that GRAT, anything that the assets do, any growth that occurs above and beyond that 0.6% remains in the trust and can be passed to generations, younger generations, tax-free. So that's a really good technique. The second one, a charitable lead trust, is one that's for the charitably inclined first and foremost. And again, what that is designed to do is to transfer wealth to younger generations, but also create a current income tax deduction, current charitable income tax deduction. And again, you would transfer assets to the trust. In this case, the annuity is paid to a charity for a number of years. At the end of that annuity term, what's ever left, again, what's ever grown above and beyond the 0.6% is there in trust, tax-free for younger generations.
So there was a lot of planning techniques that Aaron, you just went into. And one of the things that we were actually talking about prior to the webinar, we talked about just having the end in mind objectives in place to crystallize what clients are trying to accomplish, and then back into strategies. And one of my concerns when I'm addressing clients is that we know that that time is right on our side right now. We know that the estate tax exemption, which is limits for gifting, is scheduled to go down in 2026. And with the growing deficit and stimulus, we have an absolute need and responsibility to raise taxes in the future. And many times that is against the wealthy as they're first to take the hits. So we know that there's a good opportunity for the wealthy to transfer their assets to next generations, but at the same time, they're concerned. Nobody wants to build up their net worth and finally get to a point where they're really comfortable, they feel good about where they are, and then just give away all their money. So there's strategies that could come into play that help maintain that control. Aaron, could you speak more of that, maybe in layman's terms, to talk about what people could do now to take advantage of this opportunity that's going to change sometime in the future, while not giving up control necessarily, so they could still enjoy their wealth?
Yeah. So you mentioned that there's this $11.5 million exclusion. So each person, a married couple, have the ability to exclude from estate tax $23 million of assets, 11.5 per person. And that is, and again, that's against an estate tax of 40%. So, saving estate tax on $23 million is about $9.2 million worth of tax savings. You're correct. That is supposed to go down by the end of 2025. But I'm fairly confident that if Joe Biden is elected president and or control of Congress shifts to the Democrats, that exclusion will go down next year and it may be eliminated. And so the time to act is now, right? But everyone's obviously concerned because values are low, and the conventional wisdom was, gifting things away to younger generations that would result in the client losing control and access to the funds. So with that in mind, what we're doing is creating what's called spousal lifetime access trusts, where a client would create a trust for the benefit of his or her spouse and children. And in that fashion, with the spouse as a beneficiary of the trust, the spouse and arguably indirectly the client would have access to those funds while also having given them away and moving them out of their estate for estate tax purposes.
Interesting. So they're able to start transferring their wealth today ahead of those changes while maintaining that control of the assets in case they need it later on. So that's great. I want to remind people, as far as if they have any questions that they want to ask along the way, well, it will remain confidential as far as where the questions are coming from, but please type them into the Q&A box so we could address any concerns that come up along the way. I want to come back into, what are some of the misperceptions that, and I think we touched upon this a little bit, that clients, well, let me get to a different question. Actually, I'm going to go to Marco. For real estate planning opportunities, what are some of the tax planning strategies that are coming into play right now, especially now? I mean, you mentioned opportunity zones, but for clients that have built up a significant net worth in real estate, is there anything that they should be considering now as pertains to planning?
Well, I think, that might be more on the estate planning side. I don't know, Aaron, what your thoughts are? On the income tax side, there's some changes in with some of the new legislation that came out in terms of qualified improvement property, but I'm not sure if that's what you're getting at.
Sure. I mean, why don't you expand on that a little bit?
On the qualified improvement property?
Yes.
Yeah. It was kind of a glitch from the 2017 Act that improvements to non-residential property could not be expensed, and the act that was passed in response to the coronavirus had kind of fixed that and permitted essentially made it effective as of the 2017 Act, which was at the end of 2017. So taxpayers can go back who have qualified improvement property for 2018 and 2019, and where that property is put in service and expense that property.
Great. Aaron, do you have anything to expand on that?
No, I don't.
Okay, perfect. We had some questions that have come in about GRATs. How are the interest rates determined for GRATs, and why 2-year GRATs? Yeah.
So first of all, the interest rate is required by the IRS, and it's what's called the 75/20 rate. And along with the AFR rates that are issued every month, the IRS issues a 75/20 rate. And for the month of June, that rate is 0.6%, the lowest it's ever been. So that's the interest rate that's determined in calculating the annuity. And then the reason we use a 2-year GRAT is because if the client who's creating the GRAT dies before the GRAT term ends, everything that's put into the GRAT is then back into the client's estate. So we recommend 2-year GRATs because we want to, hopefully make sure that the client outlives that 2 years. And what we do is we just continue to roll over assets with rolling 2-year grats year by year.
Great. How about qualified personal resident trusts? What are your thoughts on those?
Yeah, so qualified personal residence trust is real quickly is a trust. The client would be putting their personal residence or vacation home, second home, into a trust, and they retain the right to live in the trust for a number of years, 5, 10, 15 years. At the conclusion of that term, if they've survived the term, the asset, the house stays in trust and is in trust for the benefit of the beneficiaries of the trust, typically younger generation. Like the GRAT, the client has to live the term in order for the technique to be successful. And that is a planning technique. The problem that I've run up against with QPERTs is the value of homes don't substantially appreciate, so that it makes it, an entirely worthwhile exercise. So unless you think you've got some real estate that's going to substantially appreciate, you really got to weigh the cost benefit analysis of the cost of doing it and all the other risks associated with it versus, the tax savings you're really going to enjoy from that technique.
An interesting question came up about flexibility again. We talked about earlier spousal lifetime access trusts, which is a way to provide some flexibility for the grantor or the person creating the trust ultimately to maintain control of the assets while gifting it to the next generation. But what happens in the case of a divorce with these type of trusts?
Yeah, so as I had mentioned, the SLAT, the Spousal Lifetime Access Trust, is typically set up where the client sets it up for the spouse and the children. And we talk about the client having indirect access through the trust through the spouse. What happens if there's a divorce? So there's a few things I do to address that. One is I typically provide a provision in the trust that says if a divorce occurs, then the spouse is no longer considered a beneficiary of the trust. But then that now creates an issue of how does the client get access to the trust? And what we've been doing there is, one, we include an ability for the client, in this case the grantor, to have the right to borrow money from the trust. And that actually is one of the powers you can give to the grantor to make it a grantor trust for income tax purposes. We're also considering putting in powers of appointment to a person who, through that exercise of a power of appointment, could in essence include the grantor client as a beneficiary of the trust down the road, should something like a divorce from the spouse or death of the spouse occur.
So this is an interesting question that came in, and we've been asked it along the way multiple times for the past few months. Some businesses have taken a temporary hit. I mean, I could think of hotels that are getting annihilated right now. Many restaurants are getting hurt very bad. Sports franchises may be getting hit. I mean, there's a lot of businesses that are taking a hit, which likely will, return hopefully to a more normalized level in sometime in the future. So, given these reduced temporary values, what are some of the things that we could do to, from a planning perspective, take advantage of these reduced values and do some good work?
Yeah, Marco, I think that's, maybe talk about the 1202 stock planning technique.
Yeah, for kind of a background, 1202 is a favorable division of the code. It became more popular recently because it operates as if you've held a C corporation stock for at least 5 years and it meets certain other qualifications, you can exclude 100% of the gain from the sale of that stock. And but before it had been 50%, so it now that had nothing to do with Corona. That was a few years back that it was increased to 100%. So if you're not in a C corp now, if you were to convert in a flow-through entity, if you're an LLC or partnership, you can do so. Your 5-year clock starts running from the day that you convert, and you don't get the benefit. You don't get to exclude that built-in gain that existed at the time of the conversion. So now values are low. You can capture more of that benefit, that exclusion, because I'm sorry.
He's leaving his, in the White House. He's getting interrupted like that. It's amazing.
You know, I thought I had people for that. But you can increase the amount that you can exclude where you've been. That's subject to this 1202 exclusion. You know, and it also, you know, operates for those folks because the limit is on people. You can only have $500 million business of $500 million of assets. So if you're kind of at that borderline, you wouldn't be able to take advantage of 1202 stock anyway. Now with the values coming down, you know, we think that there may be some businesses that could take advantage of that if this temporary decrease in value has now brought them under the limit.
Does this have an impact on acquisitions, as far as if you're acquiring a company right now, making any, considering entity changes or along the way?
Yeah, it's really, I think it's really part of the broader question of whether you're in the right entity. We talked about, this is a play going from a pass-through to a corporate entity. And, with the expectation that would be, of course, be most beneficial if you're expecting that you're going to have a lot of growth over the next 5 years that you want to exclude. There's also the possibility, under the choice of entity, to go the other way. And, if you're in a C Corp and you're thinking, well, I think corporate rates are going to go up, or, for other reasons, to get out of the structure, if you have some NOLs, when you convert to an LLC, to a flow-through structure, it's a taxable event, and the amount of the gain that you recognize is based on the value of the company. If you can, if now we're in depressed values, you can have a valuation that supports that. Then you can convert to a flow-through structure, especially if there are net operating losses, without as much tax cost.
Aaron, were you going to say something before?
Yeah, I was just going to say that in connection with clients that I'm representing who have substantial real estate holdings, some of the market values of those holdings have declined substantially, and looking into the ways we can do some wealth transfer. One of the impediments or hurdles has been, these negative capital accounts, and the prospect of passing that on to younger generations with that inherent negative capital account, which could result in some substantial income tax consequences on a disposition of the real estate. The typical, option was unfortunately death, because that resulted in a step up in basis and an elimination of those tax consequences. And of course, there's the opportunity zones and like-kind exchanges, but again, those only really kick the can down the road. So what we've been looking at and working on are creating these partnership freezes, where we actually take the client's interest in the real estate holdings and contribute it to an LLC and create for that client a preferred interest and a common interest, or preferred units and common units. The client would retain the preferred unit with some preferred rate of return and gift the common units. And by doing that, what the client is doing is gifting the common units, which is all of the future appreciation, to younger generations, but keeping the preferred unit, which holds, in essence, the basis with the negative capital account that does not grow. It stays fixed, but would get a step up in basis on death.
Great. There's a question that came in, and just gonna kind of reiterate something that it's a fear that I have with this current environment. you know, it's uncertain times, so a lot of people are kind of frozen. They want to wait and see what's going on with their businesses, the economy, the stock markets. So, you know, they may have been putting off planning, but it is so clear to the advisor world that there's never been a better time in at least the past 20 years that I've been in practice to do very thoughtful planning with your overall objectives in mind. And there's a lot of control and flexibility. To that, I'm going to open up the question that came in about expanding on slats, because that's a very popular way to achieve objective of gifting assets while maintaining control. So the question was to get more into the weeds as far as the mechanics of how they operate, what type of assets go into the slats, and the ideal client that would find this suitable.
Yeah, so, you know, first and foremost, the slat technique is designed to take advantage of the $11.5 million exclusion. And while, you know, the best asset to put in would be one that's going to highly appreciate over time, any asset can do. I mean, I've seen plenty of clients put marketable securities into a slat. And again, you know, that's not really taking advantage of discounts for lack of marketability and lack of control, but you could conceivably put those marketable securities in an LLC and then move LLC interest into the slat. And then as far as the terms are concerned, you typically would have someone other than the client and their spouse as trustee. And you would provide that income and principal can be distributed to the spouse or the children, you know, for a broad standard or any standard. You know, I'm seeing more of a push now than ever before to create dynasty trusts, which are trusts that will survive not only the kids' generation and grandkids' generations, but even beyond that point. So they're really flexible, you know, the terms. And what we do, by the way, is we try to create slats that have flexibility because circumstances change and clients' feelings change about how they want to leave assets to the younger generation. So, you know, we'll provide mechanisms where we're able to decant the trust in the future. If need be, we give the grantor the power to remove and replace the trustee. We work with powers of appointment, which would allow for a recalibration of what you're leaving to beneficiaries and how you're leaving it to them. So while it's irrevocable and it's a commitment to a gift, we do create something that's fairly flexible and workable as circumstances change.
I could confirm that. I mean, we've worked on mutual clients in the past in which we've designed them for that matter to for the flexibility in mind and some of these contingencies, you know, in case of divorce, in case of a need for later on. So the most important thing is when we're dealing with our clients is really to have a good conversation as far as what are the objectives that are in mind and then backing into the strategies. One concern that I have, I've had the privilege of working with a ton of estate planning attorneys over the years, or attorneys. And I really believe that sometime within the next 6 months, as the new year comes into play, there's going to be an influx of demand, especially if Mr. Biden wins. And quite frankly, you're going to see general practitioners trying to put these strategies in place. And there's going to be, because the better planners that have been doing it their whole career are not going to have the capacity to manage the influx, which is why we're trying to kind of really encourage people to take action now, because there's so much flexibility that exists, which people don't realize. How about from charitable planning perspective? You mentioned one component earlier as far as gifting to charities, but have we seen an uptick in charitable planning? Aaron or Marco?
Marco, I mean, I've got some thoughts. Marco, you want to weigh in on that at all?
No, I haven't seen any, you know, anything on that aspect.
Okay. I'm not sure that I've seen an uptick, Ari, in charitable planning, but nevertheless, you know, that is part of the planning that I'm doing, I would say that I'm seeing it really comes into play with those who are charitably inclined. I mean, I think it begins there. And instead of looking at a tax play, I really approach it from the perspective of the client looking to do something charitably, and then, what's the most efficient way to do so. And, of course, we're looking at things like naming your IRA, naming a beneficiary of your IRA, your charity as a beneficiary of your IRA, or if you're in a situation where you're taking required minimum distributions, maybe having those distributions earmarked for a charity as opposed to taking them, because as you know, there's some limitations on the charitable deduction on your tax return. So, sometimes it's more efficient than paying income tax on the distribution from your IRA and then turning around and making a charitable deduction, just making it directly, from that IRA account. And then, like I said, the charitable lead trust is an excellent device, particularly if you've got an asset, not one that's already appreciated, because that would be a charitable remainder trust, but one where you think it's going to appreciate in the future, hasn't yet, and you're charitably inclined and you want to leave, assets to the younger generation. The charitable lead trust would be a good technique.
So I co-chair the endowment campaign at my kids' Jewish day school. So it's an area that I'm passionate about, and I've found in my career that actually a lot of clients are charitably inclined, but they need to be asked the question. And if they're not asked the question, then it's not included in their estate plan. So which is just an interesting revelation that I've come across for the years. A question has come to me about how are changes in the insurance market impacting estate planning? So, the insurance market, it's really interesting. A lot of people were very concerned about the ability to obtain life insurance because of COVID-19. And as a result, some changes have been impacted because high-end large insurance policies many times are part of overall estate planning. And it's not just for the ultra-high net worth, it's for really clients of any net worth. If they have more money than they need, and from a retirement perspective, there's a good chance if they want to leave money to their kids, insurance is an efficient vehicle to do so. So the impacts of the market have an impact on overall estate planning. So not COVID-19, but interest rates have had a massive impact on the insurance market. The insurance companies collect your premium, and they're going to pay out about as much as they collect in premiums in death benefits, but their profits are mostly based on the money they make on your money, which is invested conservatively. So low interest rates are having a very damaging effect to pricing. So what we see, and we've been talking about this a lot, is cost of guarantees are increasing. So if someone wants a guaranteed permanent insurance product or even a long duration term, the prices have started to go up and are likely to continue to go up for a while. So again, that's a timely opportunity to take advantage of pricing today, which is likely going to trend for the worse. COVID-19 restrictions are starting to lighten. Most of the restrictions were about how much premium insurance companies could take, so meaning maximizing $1 million as a premium, and against elder insureds. Elder defined as, for some companies, 70 and above, and others who are 80 or above. The insurance companies would decline to insure. But those windows are starting to open up as restrictions of lightened. Insurance companies are now starting to roll back those restrictions. But pricing is likely going to trend for a while. We just got another question about testamentary trusts and the effects of losing stretch IRAs. So that's probably for you, Aaron.
That's a good question. The testamentary crut, I'm not, I haven't, to be honest, I haven't looked at that issue. I have not. I'd have to give that some more thought, Ari.
We could get back to the person who asked the question after. So we'll just mark down the person's name and report back after to address that question. So thank you for asking. Keep the questions coming in. We're closing out as far as from the questions that we have. How about in terms of overall planning? I mean, what do you think? We probably tapped upon this, but are there any opportunities that we really haven't touched upon that you could think of that really apply today because of the low interest rates, high exemptions, or do you think we kind of covered all our touch points on that?
Well, I think from an estate planning perspective, we've touched upon it. So just to summarize, what I'd like clients to consider is first and foremost trying to make sure they utilize this lifetime exclusion before it goes away, because I'm pretty certain that at least we know for sure it's going to go down 2025, but I've got a feeling that it's going to go down even sooner. So I think first and foremost, let's look at that and let's try to take advantage of that. And then, and typically the spousal lifetime access trust would be the way to address that. And then, and because of the low interest rates and low values, you really should consider the Grantor retained annuity trust and the charitable lead trust. I guess one other thing that comes to mind is because of the low interest rates, any family members or clients who want to make loans to family members or who have made loans to family members, now might be a time to look at the low interest rate and either refinance existing loans or go ahead and make those loans, because the IRS requires you to charge a minimum interest rate, and that rate again is very low. It's I believe 0.8%, and so that's a good way to help family members through a loan without hurting them, with a high interest rate.
You mentioned refinancing loans and back to the insurance market for a second. A lot of people have the perception that if they bought a policy many years ago, the pricing's as good as it's going to get because buying it later is going to be more expensive. But most policies have a cost of insurance that's based on your age today, and you're insuring the difference between the cash value and the death benefit. So just as there's a refinance boom in the mortgage market and gifting market, the life insurance market applies as well, because if someone's in good health today, the mortality tables are substantially better than they were from when they bought their policies 20, 30 years ago. So there's a very good chance they could get a better deal for the same dollars. But the more important thing, and this is really something I'm passionate about, is just reviewing why those policies are in place. Because, most policies are sold. And when they're sold, they're not necessarily as part of a plan. So any policies that exist, try to take advantage of the opportunity to make sure they're owned the right way. The beneficiaries are correct. They're efficient, that they're going to work the best that's available in the marketplace. Just do comprehensive reviews as it applies to today's objectives for you and yourself, because needs change, and policies shouldn't be bought from a transaction perspective, but from a perspective of what are we trying to accomplish. So I guess that's kind of my closing message, as to encourage people to take what they're doing from a planning perspective and make sure it's up to date. Marco, how about you? Do you have any kind of closing thoughts that you'd like people to think about during this time?
Yeah, I think the only thing I'd add that, kind of coming into this talk that I had in mind was, harvesting of losses. If folks, in their portfolios have dropped in value, they want to, if they have some gains that they want to shelter, if they don't want to put them in, put into a opportunity zone, that you can do that. And the only thing to be mindful of is the wash sale rules that would prohibit you from recognizing a loss, if within 30 days, either before or after you've invested in a substantially similar property. So trying to sell shares and then buy them again, would kind of defeat the purpose. But if you're in mutual funds, it's typically the case that one mutual fund wouldn't be treated substantially similar, so that you can kind of take advantage of the loss, but still stay in the market and catch the upside.
And I know Telemus does a great job of tax loss harvesting as well on the investment side. They've done a ton of work on that level as well, so they could help with that. So I thank everyone for attending. I hope this was informative. And just to close out, I mean, these are crazy times. Hopefully everyone is staying healthy and safe. And as it pertains to planning, that they're making sure that they're reviewing their existing estate plans, their business valuations, their existing insurance, investment portfolios, and then managing them all appropriately and reviewing while the time's right to really make some changes to leave wealth to the next generation and/or charities, and do some really good work for your families and/or organizations. And thank you all for attending.